Welcome to our latest webinar for corporates. In this series, we'll be examining recent events and looking ahead at what might be in store for financial markets and the economy. Good morning, everybody, and welcome to 2022, which has started off in robust mood as if you're looking at sterling, and confident mood if you're looking at predictions for interest rates and also for the end of the latest wave of coronavirus infection. Certainly the headlines that we've seen from the media over the course of the last few days would appear to be indicating that the wave will disappear almost as quickly as it arrived. But also that the government's plans are to live with coronavirus from here on in, although that will, of course, be dependent on what the next variant is. So in terms of my presentation, I'll look at the latest wave of Omicron and whether it's the beginning of end of this COVID pandemic. And then we'll move on to predictions for growth in 2022, what the outlook for inflation and growth means for central banks. And then I just want to focus attention on consumer confidence figures that we've been monitoring for some time, just because they might be giving us an indication of the greater economic headwinds that could be facing the global economic recovery into the second half of 2022, before turning our attention onto the FX markets and what's happening there, followed by the disclaimer, and then by Piers, who'll give you the technical update. So without further ado, I'll move on to our first slide on this latest wave of infections. And you can see from this chart that the scale of infection that we're seeing is far larger than during any other peaks. This tracks Irish, French, German, German, Greek, Italian, United Kingdom, and US levels of infection. And you can see that there's been a surge in infection over recent weeks, two new highs. Virtually every country that I'm speaking of there, with the exception at the moment of Germany, has seen new highs as far as levels of COVID infection because of Omicron. But virtually every country has seen a lower incidence of hospitalization and also mortality because of this new variant. So it would suggest that whilst it's more transmissible, it's less virulent, so it creates fewer adverse healthcare outcomes. And as a consequence, we are seeing some countries starting to relax their restrictions with regard to this Omicron wave. We saw that in South Africa, where the Omicron variant was first discovered or certainly first recognized and identified, and we are beginning to see a calling for a loosening of restrictions in the United Kingdom. Countries like Scotland, who make up part of the United Kingdom, have started to relax the restrictions that they implemented as the Omicron wave hit. And you're seeing for the same sort of calls in Wales and Northern Ireland as well. England didn't implement as restrictive a set of measures in terms of the Omicron variant, and they do seem to have been vindicated in that. But it's probably too early to sound the all clear, and we don't know what the impact of those restrictions will have been in terms of the UK economy, how detrimental it will have been to economic activity, nor indeed have we got a clear picture from any of these other economies, because if you look at some of the data, it's been better than expected. Running into this Omicron wave of infections. Some of the survey data, on the other hand, has been more mixed. So some of it suggesting that the picture is improving. Other parts of the survey evidence suggesting that particularly the services sector has taken a really heavy hit because of the restrictions implemented, and people have been naturally more cautious about socializing whilst it's been in circulation. So we'll just wait and see what that means for economic activity. But in terms of the GDP forecast, if we look at the next slide, then the GDP forecasts aren't really materially changing at the moment. These are the IMF numbers. The January update will be out in a matter of days from the International Monetary Fund's World Economic Outlook. I don't imagine that we're going to see very sizable changes to the 2022 growth forecast from Omicron, but we might see some downward revisions where we've already seen very sizable increases in interest rates. So we've seen those in the likes of Latin America, in parts of Eastern Europe, and also in some parts of Asia as well. Remember, we also had that surprise rate increase from the Bank of England in December, and I think that might have a marginal detrimental effect on UK economic activity for 2022, or at least predictions of it, with the markets also pricing in a series of rate increases in the UK over the course of 2022. So 4 rate rises are already priced for by the markets for the whole of 2022, the first hike coming in the first quarter. And the same really for the US, the imagined path of interest rates has materially changed over the course of the last 2 to 3 months, so that now 3 rate increases are expected in 2022, with further rate increases in 2023, and the risks being that the US has to be more aggressive on those interest rate increases. The only central bank that doesn't look as if it's following that path is the European Central Bank, where I think there's the potential for some upside surprise in terms of economic activity, along with some risk that the European Central Bank do have to tighten marginally earlier than is being priced for by the financial markets. And that could have a material impact in terms of how we see the currency markets evolve as we play out 2022. Certainly the second half of 2022 might prove more interesting and more volatile as we see changes to the monetary policy environment of all of the major economies. So moving on to the next slide and looking at central banks. Well, why are central banks looking to tighten policy? Because they're worried that the inflation that we've been seeing is going to prove more medium term rather than short term. Now, that's interesting when you listen to some of the comments from, for example, the Federal Reserve Chairman, Jerome Powell, who talked about inflation starting to drop back around about the second half of 2022. So that would indicate that the inflation pressures are starting to weaken. But remember, inflation is at higher levels than was being predicted by those central banks over the course of 2021, really until the final quarter of 2021, when central banks caught up with the idea that inflation driven by labour market shortages, by supply chain disruption, by commodity price inflation might prove to be more medium term. The same thing is true of the Bank of England. So they didn't hike in November, much to the surprise of the financial markets, and then again to the surprise of the financial markets, decided to hike in December. The reasons for it were unclear. Why the change was necessarily only a month after the latest round of inflation forecasts. I don't think that inflation had materially increased above what the Bank of England was expecting, but they chose that point to really ratchet back on the monetary environment, the expansive monetary environment that had been in situ since the pandemic struck in February, March of 2020. I would argue that the Bank of England in November did say that the markets were overpricing the number of rate increases for 2021 and 2022. Since then, the market has become even more aggressive in what it's pricing for. So there could be some disappointment. And I stress that in the second half of 2022, you're going to be seeing significant headwinds to economic activity in the UK and the US because of the lack of additional fiscal stimulus. Remember, in the US, in the first quarter of 2021, we saw some $5 trillion worth of stimulus to household budgets. That won't be replicated in 2022. In the UK, you were still seeing the UK government providing a tremendous amount of support to businesses. Now that's going to be reversed in 2022 with the national insurance hike. So businesses are going to be faced with higher levels of leverage and also higher taxes, alongside the risk of higher interest rates. And I think that could present some really significant headwinds to GDP growth. So whilst inflation is of concern, there is the risk that central banks will be repeating the mistakes that we saw in late 2018, early 2019, when interest rates were rising in the US, and yet the momentum looked as if it was being lost as far as economic activity is concerned. Now, central banks will probably assuage any fears that they themselves hold by saying, well, look, we're looking at labour markets that look tight. We're looking at labour market shortages in a wide number of industries, and that could force earnings higher. But for the time being, household incomes are being squeezed by higher inflation rates than we're seeing average earnings grow by. And also the prospect of higher interest rates and higher taxes. So it'll be interesting to see how that plays out. But the economic picture, I think, certainly the risks to those forecasts that you see on the screen, or that you saw on the screen on the last slide, the risks to those forecasts are to the downside if the central banks carry out their threat to raise interest rates relatively aggressively, and in the UK's case, to a level that's higher than where we entered the pandemic, and yet the UK economy is yet to demonstrate that it's recouped all of its lost economic output because of the pandemic. So interesting to see how that plays out. So if we move on to the next slide, and this is quite a busy slide, but it does demonstrate that consumer confidence is lower than it was realistically at the time prior to the pandemic. So whilst other economic indicators are suggesting that things are moving forward again, that the economy has regathered its momentum, from a consumer perspective, I think consumers are still very nervous, and that confidence is relatively fragile. So consequently, if there are some signs that inflation is more persistent and that it's taking a bite out of household incomes, then I think that we could see confidence dropping further. And it's worthwhile noting that some of the consumer confidence indicators, like, for example, the University of Michigan Consumer Sentiment Index in the US, have been dropping recently, and that despite the improvement that we've seen in labour markets. So that suggests that temporary effect that I was talking about from the household stimulus that was seen via the checks cut for each household in the first quarter of 2021, that support to consumer confidence is already being lost. Add into that, I think that the supply chain disruption that we've been seeing is going to cause some limited shortages of a variety of different retail goods over the course of the early stages of 2021, and that may be exacerbated by the Winter Olympics that are due to be held in Beijing in a couple of weeks' time. That I think could also have a material negative effect in terms of supply chains over the course of the next month or two, in terms of that a lot of those factories in and around Beijing are likely to shut down to improve the air quality. And that additionally will add to the Chinese New Year disruption that we've already been seeing. So just watch out for that. Watch out also for a further rise in terms of energy prices. There's some stories that we've seen in the press lately that suggest that supply is still being restricted by Russia to to the rest of Europe, particularly to continental Europe, and that is causing a renewed rise in gas prices. We've also seen oil prices rising as well, so that could have an effect on petrol and diesel prices if it persists for any length of time, and that could equally have a materially negative effect on consumer confidence over the next few months or even few quarters. So if confidence doesn't improve, then I think that will be an additional barrier to the economies recovering at the pace that was being suggested by the IMF back in October. But as I say, I don't think there'll be any materially negative downward revisions to the forecast for growth at this early stage. They may well come in the April or July updates from the IMF. But there is one further question to ask, which is whether consumer confidence data is a good indicator of future economic activity, because there are a few other levers that are influential in terms of economic activity, and for the likes of the major economies, it will also be driven by business investment or fixed investment in those economies. And what is the outlook for that? Well, there too, I think the potential for higher interest rates, higher taxes, and higher inflation could produce an unedifying mix for investors if valuations remain at the levels that they are. So there is a risk that we might see equity markets coming under pressure as well if the environment remains as adverse from an inflation, interest rate, and fiscal policy perspective. So just keep an eye on confidence indicators, not only for consumer confidence but also business confidence, because that might give us some indication of how robust the 2022 recovery will be. And then moving on to the currency markets before I hand over to Piers. Well, the dollar has slipped back, and we expected as much in terms of some pressure to be brought to bear on the dollar. I don't think that the dollar's in line for a significant period of additional weakness, but against sterling, because the markets are pricing in so many rate increases, in fact, more rate increases out of the UK than in the US, that might help to hold up sterling against the US dollar and also against the euro, where there's no interest rate increases expected from the European Central Bank. I think that the risks as well are for greater volatility in other currency markets, because I think we're going to get to a point where it's less obvious what central banks are going to do with regard to monetary policy, particularly in places like Latin America, Eastern Europe, Africa, and the Middle East. I think that the prospect of raising interest rates aggressively and the damage that could do to economic activity might start to weigh on central bank thinking. So you could get a greater amount of volatility as there's greater uncertainty over the path of monetary policy again in the second half of 2022. Before I hand over to Piers, I'll just finish with the disclaimer slide that I normally do. So this just says, again, we're not offering advice here. But if any of the commentary you've just heard from me is of interest, please feel free to get in touch if you want to arrange a one-to-one. And with that, I will hand over to Piers. Piers, can you give us the technical view after you've heard the fundamentals? Thanks very much.
Thank you, Neil. Thank you very much. Just check I've unmuted myself. Yes, looks like it. Thank you very much, Neil. Fascinating stuff as ever. So I'm going to look at the markets a slightly different way to Neil. Neil looks very complex. He understands all the information that comes out, and I don't, basically. I just look at the price action. So let's have a look at the first slide, and we're going to start with the dollar index, because really everything's traded against the dollar. Everything else is called a cross rate. So once you know what the dollar's doing, it starts to help give you a view of where the FX rates are going in the world and other markets. Now, I think this year will be a very difficult year to forecast. Now, I said that in the webinars at the end of last year. I said that we've had it easy, for the last sort of decade. All it's been is interest rates flat. There's been no talk of raising interest rates. Suddenly interest rates rises are coming. We're seeing equity markets all over the place, treasury markets all over the place. And as a result, FX sort of all over the place. Now, the one thing I look at is where is it in relation to major levels. So on this first chart here, I have all the information going back to 2000 on the dollar index. And we can see that fall from 2000 down to sort of 2009, the financial crisis. And then the dollar started to get strength back and start climbing back up. But there's two purple lines. And if we zoom into the next slide, we can have a look at those two purple lines a bit clearer. So one is the 38.2% and one is the 61.8% Fibonacci retracement. And those two levels are key. If you've ever watched any of my presentations, it's key levels where the buyers and sellers take their positions. So we can see when it broke the 38.2, the bottom purple line, it then over the next few years went up to the top purple line and fell off, the 61.8, and then fell back down to the bottom purple line, the 38.2%, which also was the trend line. So it then bounced and rallied off there and went back up to the purple line, the 61.8%, and that's where the sellers come in and they sold it. And as it came off last time, and it came back to the 38.2 and bounced, the key thing was it broke that uptrend line. Now, the market has rallied back up, and in that red circle where the arrow is pointing to, you can see that last quarter, it stopped right on that line. And where are we now? Right on the 50% line this quarter. So the market's really unsure where to go. You're right in the middle of the two main. So I always regard it as a battlefield between the bulls and the bears. And you're right in the middle of the battlefield. Now, at the moment, because you've broken the trend line, while we're below that trend line, I feel the risk is we could start to see the dollar weaken and come off that trend line. However, if prices were to get above that trend line, then I'd change because the facts have changed. The buyers have got it back above the trend line. But at the moment, the sellers are selling it off that trend line. And I think the risk could be for a bit of a weaker dollar. And if we go to the next slide, we're going to have a look at euro dollar. And here, what can we see on euro dollar? Again, here, euro dollar, a long-term quarterly chart. Now, I put this slide on last month's webinar, and you can see there's a multi-point trend line at the bottom, a long-term trend line going higher. Now, while you hold above that trend line, you look for a bounce higher. And that sort of goes in with the dollar weakness a bit, that the market should bounce. But if you get below that trend line, then we have to change. So you have to be very, very nimble this year and ready to change if the market suddenly reacts and breaks below the trend line. But at the moment, you're above the trend line. We look for a bit of a rally. And on the next slide, I zoom in just to the price action recently. And this is for the last couple of years, a monthly chart. And we can see that one of the areas I had last year was 112.40. I had 112, 113 as a target zone. Now, where did I get that from? Well, last year we broke through the 38.2%, that purple line. So if you look at the rally up, we had from 2019 to early 2020, and it went up to one sort of just above 123. Then the market started to fall. It went through that 38.2%. That became resistance. The market fell to the 61.8%, and it's bouncing off there at the moment. So while that 61.8% at 112.90 and the 112.40 area, while that 50 pip area holds, I'd look for a bit of a rally in euro dollar. But again, we know where we have to change our view. If you get a monthly close below 112.40, then we have to start thinking about where are downside targets. But at the moment, while we're above that 112.40, 112.90 area, I think the risk is a test higher towards the 115, 116 area. So remember, these are start of year markets, so they're always a bit more nervous. And you have to just be careful. Is the initial move the wrong move? But I think it'll be a very, as I keep saying, you have to be alert this year because there, as Neil talked about, there's lots of potential rate rise. There's a lot of information that could impact the markets. Right, if we go to the next slide, we'll have a look at sterling. So the best way to look at sterling, I feel, is to start with the sterling index, because then we don't have to go through lots and lots of different charts. We can just see what is sterling doing as a whole. It's like looking at the FTSE for stocks and shares. Once you get a hold of, is the FTSE rallying, then you'll know what most shares are doing. Or is the rallying over and it's coming back down lower? So what do we see here? Well, something I've banged on about and gone on about for years, the last, 5 years really, since 2016. All the rallies on the sterling index have been held by the 38.2%. You can see that line in purple, and it's held every rally we've had. We've had spikes through it a couple of times, but by the end of the quarter, it's come back down. Now, this quarter, started this year, we can see in that little, where I put the arrow pointing up, we're above that 38.2%, and price is trying to rally. So what we have to watch is, can it hold above and close above that line for the first quarter? Because if it closes above that line on the first quarter, it opens up the 61.8%. So we have our two purple lines to watch, 38.2% and 61.8%. And what's different this time is we have a trend line. If you look at that dashed orange line rising, that has caused sterling to bounce each time it's got to it. So that's where the buyers are in buying it. So we know while you're above that dashed orange line, sterling has support. So I feel at the moment the risk is to the upside on sterling, stronger sterling. However, where do I change that view? Firstly, if the quarter closes below 38.2%, it's a bit of a worry, because why did it not hold that 38.2%? But the real risk to sterling is if you break below that trend line. Break below that trend line on a quarterly close, and suddenly what's happened? Something's changed. Now, one of the things I try and say on markets, and it's something always to keep in the back of your mind, I think the main thing that could impact markets this year is something that people aren't talking about. We've seen so many examples of that through time. Like the other year, everyone had views on the market, then COVID came along. No one had that in their start of year predictions. It's those things that blindside you that knock the price, rather than things that we all talk about and say, look, we know this, we know that. So we have to be aware of that trend line. Something could come along, blindside sterling, take it down. So we move to the next slide. We're going to look at sterling dollar. So sterling dollar, here again, we have a long-term downtrend that's been in place. So this is the move down from 211.61 back in 2008 down to 118.41 in 2016. So it was a very large move down. But price has broken below. Let's actually zoom into the next slide. We can see it a bit clearer there. Right, so this is the end bit of that chart we were just looking at. So you can see the trend line coming down, and the other year, price broke above the down trend line, which we had on that previous chart. So it was a long-term move, and it pushed higher. But where did it stop? It stopped at that 23.6%, the first retracement level. And that's 140.40. And then we also had above that, from the rule of polarity, 143.25, which is the line. If we can just go back to the last slide for one moment, I'll show where this comes from. So if you look at the lows over 2005-9 area, and then again towards 2014-15, you can see the market bounced off this area. But once it broke below it, it came back up 2019, it found it as resistance. So it's called the rule of polarity, where resistance and support swap round. So you can see the market fell off that, it came back down. And then if we go back to the next slide, you'll see here clearly those two moves up to that 143.25. The market's bounced off it both times. Now, that's the area you need to close above on a quarterly basis to say, yes, sterling dollar is going higher. Where does sterling dollar start to look a bit under threat this year? If it gets back down below 130.150 on a quarterly close, that's not good, because then it shows that this start of year sort of rally and the hold it had in the last quarter is starting to go. Now, there could be something happening on sterling dollar which will affect the longer term picture. And it's quite a big basing formation called an inverse head and shoulders. So we go to the next slide. Here is that same sort of chart that we looked at just now, but I've taken off all the retracements and we're looking at what's called a basing pattern. Now, this pattern hasn't clicked in yet. So I say this has not formed yet, but it looks like the risk could be that it is forming. So it's good to be aware of it. So we can see price has gone below this black line that I call the neckline. And then it's rallied back up to the neckline. And there we call that the left shoulder. Then price falls, goes lower, makes a new low, comes back up, hits that black line again, comes off, and now it's starting to rally up. Now, it doesn't make a lower low than the previous low, which was where we're putting the head. Now, if we get above that neckline, then that would be something called an inverse head and shoulders. And you take the height of the head, you add it onto the neckline, and you project it up. And currently that height is about 28.76 between the neckline and the height of the low of that head there. So if you added that on, say, for example, if it broke out now, you'd get a target up in the 170s. So because the neckline at the moment is 142.88 area plus 28.75 comes in about 170, 163. But it hasn't clicked in yet, so that's not the live target. The neckline is downward sloping. That's always good. On a good reversal pattern of a inverse head and shoulders, you want the neckline contra the basing formation. So if that does break through, it'll be a bit later in the year, but it's just something to keep aware in the back of your head. Now, the right shoulder can still go lower and rally back up and click into that neckline, just so long as it doesn't go lower really from the bottom of the left shoulder. If it goes lower from the bottom of the left shoulder, it starts to lose its power or impact. So really keep an eye on that, something we'll keep an eye on during the year. What is that right shoulder doing? Is it going back lower and taking away the risk? But just be wary, because that 140 area is a very big area. If we can just go back to the slide before, look at that. So the 140, 143.25 is a real key area. So at the moment, I would expect to move up towards that 139, 140 area, and that would be initial resistance. And we really have to see, how does sterling dollar do when it hits that, well, if it hits that 139, 140 area, how does sterling dollar do there? Where does that risk start to go away of this stronger sterling dollar if we start to go below 131.50? Now, finally, we're going to look at euro sterling. So we can go on a couple of slides. Yeah, that's it. This is the one, euro sterling. Thank you. So this is a chart I've had on for some time. I've warned about the trend line break. So we had that dotted orange line. We broke below the trend line. The one area holding it was the 38.2, but we retested towards the trend line. And then the market failed at the trend line and started going lower. So last quarter, we closed right at the trend line, at the 38.2%, which is 0.84. And we've started this year with sterling pushing that down lower, euro sterling pushing lower below that 84. And that's quite key. The key will be, does it hold below there? And if we can finally look at the last slide I've put on there, I've added a couple of lines on this just to sort of try and gauge the strength as we go along. Because at the moment, markets don't go in a straight direction normally. So we know where that 38.2 is. That's at 84. And that's sterling euro wise, that's 119.03. But we could see a bit of a rally back up. But I think if you rally back up in euro sterling, it should stop by that 85.07 area. So that's if you see dips in sterling euro, you should see that dips sort of held by the 117.5 area. And while euro sterling rallies are held by that 85.07 and it comes off there, then I think there's a risk that we see 82.20. Now, 82.20, I would imagine there to be some good support at that area. So watch the 82.20 area for a bit of a bounce. It might go to 82.20, then go up towards that 85.07 and then come back lower. I think that in sterling euro terms, you watch 117.55 for dips. You see 121.65 as an area of resistance. But if that 121.65 breaks and you see a quarterly close above that 21.65, I wouldn't be surprised to see a move towards 127. And so on euro sterling, that's if you break below 82.20, I wouldn't be surprised to see a move down towards the sort of 78.40, the 61.8 area. Remember, these are long-term charts, quarterly charts, so they're not something I'm expecting to happen in the next few months. This is a much longer-term, bigger picture, which we tend to do at the start of the year. And that's been a lot of information in there. So I know we have time for questions afterwards, but if anyone wants to pick up on any of these topics, please talk to your NatWest salesperson and we can sort of come back to you with the answers or do a call. But that's it from me. So I hope you've enjoyed all this stuff that I've done and have a good year.
Thank you, Piers. So we're a few minutes over. Apologies for that. But I'd like to thank everybody for joining the call. If your question wasn't answered, we'll get back to it. But we do intend to host the next call on the 2nd of February, and we look forward to seeing you then. But thank you very much for dialing in and have a good rest of the week. Thanks very much.